first home buyer or investor, how to choose the best option for you? This is one of the first questions that we get asked every time. Renting and investing is better, or buying your house is better. Buying an owner occupied property itself can take a bit longer to buy. So, what is the right strategy for you? Of course, finding the right property which is going to go up in value is going to be very, very critical. So, that's where a lot of professional advice is required. Welcome, everyone. This is Julius and Mudit here today, and we are from PropWealth and Nfinity Financials, and we are going to talk about the new webinar on rent investors. So before we begin, just a few disclaimers that the information we are sharing today is purely generic in nature. This should not be construed as a financial advice or for any particular specific scenario. So for your own personalized scenarios, take help from the concerning or the related professional, whether it's an accountant or a financial planner or a mortgage broker or a buyer agent. So that's very important. This is all generic in nature. So this is from our side a series where we disseminate some education, but for your own specific thing, you need to take, for your investment decision, you need to take the advice from the corresponding advisor. And yes, here we are. The topic today is first home buyer or investor, how to choose the best option for you. Now, like I said, that it's a very dear topic, and the reason is because a lot of people, a lot of first home buyers especially, who are just entering the market, this is one of the first questions that we get asked every time, especially given the housing prices in major cities. They've gone a lot higher, especially post-COVID, and slowly people are realizing that if it is not in the budget, but if they want to enter the property market, what is the best way forward, right? So either wait for a longer time or enter now and change the strategy. So these are two very different paths. And today we are going to cover the pros and cons of each one of them, and how do you move forward with, if you are already on a path or on the other path, then how do you move forward? Or if you're sitting today where you want to decide that which path should you take, renting and investing is better or buying your house is better, I think we will be covering this in a bit of detail today. The agenda, just going through briefly, why PropWealth? Then we're going to talk about investment status lookout. We will also cover, of course, the pros and cons of rent investing versus first home. And then we'll do case studies on how each of them works. Then we'll talk about PropWealth next. And then we're going to talk about next locations. Okay, so here we have Julius with us. Julius, he's the founder and he's the head of research and property acquisition with PropWealth. Julius has almost 15 years of experience in IT. Specializes in data, a lot of data research, algorithms. That is his forte. That's been his forte, and he's been a savvy investor across multiple countries, and he has a massive hands-on experience around sourcing, property acquisition, and he's been just helping clients a lot. If you look at his profile online, if you look at the kind of reviews he's got, you'll be amazed. Hi everyone, this is Mudit, myself. I am a director at Nfinity Financials. Nfinity Financials, we are two partners, Parag and myself, and thankfully I got educated at premier institutes. I did engineering from IIT Kanpur, went to IIM Ahmedabad, did my MBA there, and I'm a serial entrepreneur. I have close to 20 years experience across finance, strategy and technology. In my current capacity, I help people structure better strategy around their finance and the mortgage side, so that they can be on the right strategy which is attuned with their goals. And Nfinity Financial is ranked in the top few mortgage broking businesses in the country now. So we have scaled a bit. Now, one question: why PropWealth? PropWealth is a buyer agency which focuses a lot on data research and works in the best interest of clients. Just to say that in terms of property, the research, data, and strategy, these are three key pillars. Now, PropWealth has already done roughly 380 deals, and the total value of property purchase is roughly $260 million. It's not a small number, given that the PropWealth is not a not a decades-old company. And the properties that PropWealth has bought, there has been 36% equity growth just in 12 months. Now, these are very impressive numbers. It's a premium buyers agency, and it buys properties across Australia and recently they've come up with something called Prop Wealth Next. Julius is going to talk more about it in detail. How the data works, what kind of comparisons and pattern matching do they do. He's going to explain that a bit. Okay, let's take a step back and first understand that when we talk about buying a property, right? Of course, if you're looking to buy a home, that's one thing. Second is about buying an investment. Now, investment can be done in multiple ways. Now, there are multiple investment vehicles. So first question, and I would like to just understand a bit from you as well. It's a kind of a poll, but you can just type in the answer in chat. There are different asset classes, whether we talk about shares, properties, bonds, crypto, cash. In your understanding, which one do you think has been the most in terms of return on investment? What do you think which will be the highest out of these? If you can just say, let's say 1 for shares, 2 for property, 3 for bonds, 4 for cash, 5 for crypto, what's in your assessment? If you can just type in your answer in the chat, that will help me understand a bit about where you're coming from. And if we're talking about Australia, how has the Australian market been? You can just type your answer, that will be great. I think the poll is disabled, the chat window is disabled. You can type in Q&A, the Q&A section. Yeah. Properties, yes, we're getting property as the answer. Shares, okay, yeah. All right. Crypto, properties again, all right. Okay, cool. Thanks for your answers. Let's look at the graph, and this is a graph across not 5-10 years, but across a larger time period, across roughly 100 years. And this is Australian market, different asset classes, how they have performed. If you look at it, properties and shares both have grown something in the range of 10 to 12%, 10 to 11% CAGR year on year, which is quite a decent growth when we're talking about almost a century. So that's the reason. Now, when we ask this question that, okay, which asset class should I invest in? Of course, the return on investment, risk appetite, and all of those factors become important. From a return on investment perspective, properties is up there along with stocks. And we'll go into more details about which one is better and why. Okay. All right. And if we talk about Australians, having said that, property is pretty high in terms of return on investment. But if you look at how much ownership of where is the money invested currently? A large amount of money is currently still in savings account of people. And then there is roughly 12% in shares, properties approximately 8%. Then there are ETFs, managed funds, term deposits, all of that. But 30+% money, people, they have their money is sitting in cash, sitting in the bank. Now, is that the right strategy? That's a question. Many people ask us this question, and we are going to explore this question a bit more, that just keeping the money in savings, is that helpful for you, or is it eroding your financial wealth? Should you invest in one of the assets? If yes, which one, why? So this is what our exploration is going to be about. Yeah. So to invest or not to invest? That is the question. Okay. Before I go on to explaining this, when we talk about first property especially, there are some factors where we are trying to weigh about what are the pros and cons of investing or buying a property to live in, right? If you can just, from your experience or what's going on in your mind, if you can just share, and you can type in the answer there, that what is your reason which makes you confused between first investment or buying a house to live in? It could be social pressures, it could be family expectation, it could be budget, it could be lifestyle, convenience, it could be there are multiple schemes, it could be is it financially prudent or not? So if you can type your answer, first, social pressure, second, family expectation, third, lifestyle, fourth, budget, fifth, financially prudent. If you can just type 1, 2, 3, 4, 5, that will kind of give us an idea about what's in your mind, and we can tailor our presentation a bit around that and help you understand better. You can just type 1 for social, 2nd for family expectation, 3 for lifestyle, 4 for budget, and 5 for financially prudent. Which of these factors will make you decide? Yeah, financially prudent, okay. Social pressure, financially prudent. Yeah. Family expectations, yeah, financially prudent. All right. Great. Thanks a lot. A lot of people are talking about financial prudence. Some people talking about budget, social pressure as well. So I've just kind of tried to look at from 3 angles this thing: social, emotional, and financial. Now, social, of course, there's friends buying property, right? And then when we are talking to our circle of friends, we see that a lot of them are buying a property where they're living in, buying a house to live in. That influences us. Yes. Second, big important reason, family expectation. Family expectation of the family living here, and also for immigrants, it's also the family expectation of family living that they have left behind, right? So that you move to another country, buy a house there. Now, these are 2 important factors. Then emotional. I'm sure a lot of you are going through this. Emotional, when we talk about, one is, what is the stability? Does going into and living in a home, does it give me more stability as a family when I've moved here? Convenience and lifestyle. I want to buy a house which is close to my work, which is close to where, if I want to live in the city, close to there, but then budget becomes a constraint. So I want to continue living where I want to live, but the budget becomes a big constraint. So then how do I proceed further? Financial reasons. Of course, budget. Why? Because there are 2 important factors: deposit as well as the borrowing capacity. Now, if you're talking about big cities, let's say talk about Sydney or Brisbane or Melbourne. Now, the property prices have soared high. A lot of people are unable to get those kind of savings which can help them buy a house. A lot of people are struggling with borrowing capacity. The rates have just started reducing, but the rates have been pretty high for the last 24-30 months. So borrowing capacity has been a challenge with a lot of people. Then on top of it, then there are first home buyer government schemes available. There are multiple government schemes available, which as a first home buyer you can get some advantage of, and that plays a big role in deciding whether it makes sense or not. Another big factor, capital growth. If I buy this property, is it going to grow in capital or not? That is the investor's hat people want to wear, and rightly so, because historically, we also just saw that graph, right? It's a 10% capital growth year on property. So historically, properties have returned a lot of high return on investment, but what kind of property? Not every property. So when we are constrained by these factors, then we want to invest in the property, buy a property in these constraints, but also giving us growth. Tax savings, that's another one. What kind of investment will give tax saving? There are capital gains tax, there are negative gearing, there's depreciation, there are so many things which play there. And I'm sure if you have spoken to an accountant, they have given you some insights around all of them. So these are multiple things in mind. But then what is financially prudent for me to do? Should I go into and buy a house to live in, or to invest, or not to invest? Sorry. Let's talk quickly about 2 approaches here. The 2 approaches are, again, like we said earlier. First, buy an owner-occupied property. Then what happens? So we're going to explore a bit that how is it different between the 2. Okay. Let's go with the approach that, let's say if you were to buy a property to live in today. Of course, we are talking about covering all those factors that we covered in the previous slide, that emotional, social, financial reasons, and then figure out that which one, right? Today, of course, like I said, that we are going to cover more on financial, emotional, and social are very, very subjective. You will have to take a call yourself on that. But we are going to see purely from financial angle what makes more sense. Yeah? So if you buy a property to live in, then what happens as next step? First is that buying an owner-occupied property itself can take a bit longer to buy. The reason is that there are savings required for the kind of property you want to buy. If you're looking to buy a house, I'll take an example of Sydney. If you're looking to buy a house in Sydney, now getting a house below 1.3, 1.4 million dollars in Sydney has become more and more difficult. So many people, they come back saying that I want to buy a house, but then either the budget basically, either because of borrowing capacity, not able to get so much loan, or savings, because to buy a property of, let's say, a 1.5 million property, you need at least 12, 15% kind of deposit, right? So even if you take a very high loan, still we are talking about a good amount of budget required. 200K is the kind of minimum you require. Not everybody has that kind of savings. So then that becomes a constraint. So if you want to buy a property to live in, first constraint becomes that, can you buy it today or will you have to wait? Now, if you buy it today, that also what happens then, and if you're looking to build a portfolio of investment properties as well after that, then it will take some time. First of all, for the next property, which is going to be your first investment property, you will have to save for deposit. If you buy, just back of the envelope calculation, if you want to buy a property of, let's say, as low as, let's say, $500K, $500,000, you need at least $80,000 to $90,000 to be able to buy that as an investment property. So you'll have to save that money. Then you will be able to make your first investment. And then later, let's say if you bought that one, after that, if your first property was a smaller property that you bought, and that's typically what happens with a lot of first home buyers, that they buy a unit or a townhouse first. Now, because you've bought a unit or townhouse, then 3 years, 5 years down, you want to upgrade it. So PPOR is basically principal place of residence. So let's say if you want to upgrade that unit and buy a house, so then you will have to save money for that. You'll either have to, and if your borrowing capacity is becoming a constraint, you might have to sell out your unit and then buy your bigger house where you want to live in, which is kind of your dream house, or where you want to live with a expanding family and all of that, right? So that takes time again, because then you will have to either upgrade from the previous property, have some savings, and then ultimately that is where you will ultimately have a property to live in, a house to live in, an owner occupied, and maybe 1 or 2 or 3 properties kind of investment portfolio. That's a journey you can potentially take. Okay. Now let's look at the second scenario, which is where if you don't buy a house to live in today, but if you buy a property, you continue living on rent, but you invest that money into a investment property. Choice of investment property can be anywhere across Australia, because it is not commanded by, not dictated by by property value as such, because there's low emotional value attached to investment property. It being an investment property, the right way to look at it is, look, is it giving me enough return on my money? Because that's how an investment property should be. It's like a business. I invest, let's say, $70K or $100K. Now, what is the return on investment? If it is meeting that objective, whether it's a property of 300K or 400 or 500K or 800K, that doesn't matter. But that is the same thing is not true with a house that we want to live in, because house we want to live in we have a certain expectation of where we want to live, safety, security, all of that, right? So an investment property, if you invest in that, generally, if you are able to get a good investment property where you've taken the advice, you have done the research, you've done the hard work of negotiating hard, figuring out where to buy, which suburb to go to. If you've done all of that and negotiated hard and found a good property, right, you should be able to get some good equity growth in that within 1 year, 2 year, 3 year. Depending on that, you can probably use that money that you got in that property as equity. You can use the equity to buy another investment property. That's what a lot of people do. That instead of saving on your own again, because 100K saving every time is gonna take some time. So, but if in the meantime the property has grown up in value, you can use that equity and invest and get a second investment property. Now, once you have 2 investment properties, now or it could be 3 investment properties, 4 investment properties, and then you use the equity on those properties and then buy your house where you want to live in, the PPOR. And that's how you build your portfolio and your journey. So in this, your investment properties come first, your house can come later. But then you straight away buy a house which is kind of your dream house. You don't have to buy a smaller one first and then upgrade into a bigger one later, right? Now, these 2 strategies potentially, just because of investing early, investing in the right kind of property, and using that equity to fuel the growth. The second strategy, which is the rent vesting, can take much smaller time than compared to the if you buy a house to live in and then continue on that and then buy investment later. So there could be a time difference in how soon you can reach where you want to reach. Of course, it also depends on what your goal is. So this is kind of generic in nature if you want to buy a property to live in, a house to live in, and then build an investment portfolio. But we'll have to kind of look at both these in terms of what your current financials are. But broadly speaking, equity to fuel the growth can be faster than saving money on your own. An important point we just discussed was the power of leverage. I want to just take some time in power of leverage. Now, you can leverage multiple things. Leverage financials, leverage operation, leverage time, and leverage yourself. Now, each one of them, and this is important. This is important because these are the resources at your disposal, which you can use for your growth, right? So, leveraging financials. Now, that means using borrowed funds. You can take loan, different kinds of loans are available. You can be home loan, any kind of asset loan, business loan. So you can leverage borrowed funds and use that to create more wealth. Second, leverage operations. Now, if you're able to use with a high profit and you're able to reduce your cost, this can be a good way for business growth. Leveraging time. Your time is money. If you can get advice from professionals and leverage their capability, save your time, which can be used to scale the business or scale your investments. And leverage yourself. You have your own network, you have your friends, you have family, you have so many people that you know. Leverage that network of yours, and this can help you in sustainable growth. Whether it is in terms of investment property, in terms of business, both of these, this is very, very critical. And those of you who are self-employed or who are into that kind of networking, they will know the benefit of leveraging yourself and your network. Now, these are things that you can use in order to make savvier decisions and more sustainable and towards the growth. Before moving forward, I just want to take the example of power of leverage on the financial side, right? So if you were to, because we were comparing stocks and property earlier. So let's say if you were to just getting a bit onto this one, because it's an important comparison. It comes a lot of times in discussion. If you invest, let's say 100K in stocks, and the stock grows by 10%, let's say in 5%, the 100K would have converted into roughly 180K, right? So your capital would have grown by 80K. Now, if you invest the same amount of money of 100K in property, so you can possibly buy a property of 600K in 100K, because 500K, because you can get a loan of let's say 90%, and you can buy a property of 600K. Now, if this asset of 600K grows up by 10% every year, in 1 year, it will be a 60K growth. In 5 years, it will be roughly close to 400K growth. So this, if we apply the same formula of 10% growth on a property or on stock, the stock would have gone up 100K investment, your capital would have gone from 100K to 180K, while in property, your capital would have gone up the asset value would have gone from 600K to probably $1 million. Of course, there will be some holding cost, there will be some initial investment, but if you knock that off, you are still talking about a massive difference in the two. The reason is, when you're leveraging, you are using your asset, which is of higher value, is growing at 10%. While in case of stock, because there's no leverage, the asset value remains at 100K and the capital growth, the growth is 10% is on that asset. So that's one important thing to keep in mind when we talk about financial leverage. I want to take a quick case study where we can see that how, when we're talking about taking equity cash out and investing in the property, how does that work? So Jay, he's made a good portfolio. Now, we are talking about 2016, where the joint income of both husband and wife was roughly 130K. Now, they started their journey not by buying their first home to live in, but with an investment property. And because the incomes were not that great, they did a small investment. In 2017, they bought a property in South Australia the value was roughly 150k. Finding a property of 150k is not going to be so easy now. This is way back in 8 years ago. In 2018, they bought another property. This was an NSW investment property. They bought it for 350k. Then in 2019, which was next year, they built a granny in this investment property. Okay, so this was a year when they didn't buy, but they did a construction. They improved their property. In 2020, again, they bought another property in Queensland, roughly 300k under a trust. Now, trust is also one of the structures in which you can buy properties. We'll touch upon that later. And then in early 2022, they bought the house they wanted to live in New South Wales, valued at $1.2 million. And in each of these, what they did, they used the equity from their existing portfolio. Now, in 2024, they sold their South Australia property at 250k. So they made some money there. Their owner-occupied value is 1.7, investment property value is roughly 850k, trust property is now grown to 620k, and then they bought an acreage last year. Now, total loans on them is roughly 1.6 million, while the assets have grown to roughly $3.2 million. Now, that's a massive amount of equity they have built, and just from the investment property itself, the equity is worth 620 grand. So that's an example to show you that how the equity can grow and how investment properties and using the equity can help you build wealth. Now, when we talk about, like in the last example where in the last slide we saw that owner occupied, then investment properties and multiple investment properties. So if you're talking about building a portfolio, then there are some key pillars towards that. Of course, one key pillar is property, but before that comes strategy. What is your strategy? Like we said, there are two approaches. So each one of you can have a different approach. So what is the right strategy for you? Of course, finding the right property which is going to go up in value is going to be very, very critical. So that's where a lot of professional advice is required, and the hard negotiation and all of that. Then there are two important pillars as well. How is your loan structured and how is the ownership of the property structured? Like in the last case study, we saw trust or personal name. These could be different ways of it. So ownership structuring, the loan structuring, property and strategy. These all factors combine to give you that what kind of portfolio are you going to build. And we'll touch quickly upon the loan structure. Loan structure, you can have different kinds of repayments. It could be principal interest, it can be interest only. You can have different types of loans, variable, fixed, split loans, hybrid loans. And in your specific scenario, a different kind of loan can work better. Then the loan purpose of the loan could be, are you taking equity cash out? You're doing for debt consolidation, you're buying investment loan, because each kind of loan has some nuance towards it. So figuring out what loan works better for you, how do you consolidate your debts? If you are struggling with budget or struggling with borrowing capacity, then what's the right way in which you can move around? That strategy is important. A good mortgage expert can help you there. And then similarly, ownership structures. You can buy property as an individual, you can buy under trust. There's also an option to buy properties under SMSF. Now, SMSF is something which is a more complex kind of borrowing. We're not covering that today, but as an individual, if you're a starter, depending on your personal scenario, either in buying under your name or a trust, which one works better, that is something we will have to discuss, because there are multiple factors to keep in mind. One is borrowing capacity, then tax implication, negative gearing, capital growth, land tax benefits. How is your portfolio gonna be? How much kind of portfolio you want to build? Are you happy with just one property or multiple properties? Now under trust, again, it can help build a larger portfolio, and we have to consider what the land tax benefits will be. How do you distribute profits and minimize your tax? These kind of benefits can come under the trust structure. And there's of course passing on that the generational wealth we talk about, right? That how do you pass the ownership to the next generation? So these are factors which help you decide which one to choose. Now, big question. We have talked a lot about the strategy and what the structures could be and which of these can be a better one for you. But the question is how to find a great property. And that's where I want to introduce Julius. That how do you find the next great property to invest? Julius, you want to take it forward?
Good evening, Mudit. Thanks for the insightful session. So for every investor, when we'll begin the journey for the investment, whom to trust? Where should I invest? Whether my property will grow in a capital value. That's a big puzzle, right? So how to solve that puzzle? So we have introduced a software called Propel Next, which help us to identify the pockets which are the hidden gems or the emerging markets or the next hotspot where we can get into the property market early and find those hotspots so we can ride the wave of the growth. So basically, in terms of the capital growth, there are two types of growth which we achieve into the property segment. One is the short-term growth, and one is the other one is the long-term growth. Short-term growth will occur when you are riding into the boom cycle wave. Your property will grow around 15, 20, 30% within 2 to 3 years. But how that property will grow in a long-term basis, that's a fundamental question. So yes, if the supply is very low, demand is higher, definitely we'll get a good growth in a short-term basis. But why that will grow in a long-term basis? So we need to look at a lot of fundamental parameters. So we map all those parameters. We map all those parameters in our system with multiple data sources, and according to algorithm, we find the hidden gems which can grow in short-term and long-term basis. So multiple questions, right? There are more than 15,000 suburbs across Australia. Which to choose? How to find that suburb? Like, there are lots of data sources available. There is a lot of free data available over the internet. There are a lot of talk about the data sources on the internet. Which data metric to choose? So now, for example, everybody is talking about the demand and supply. But now, from last 3 years, the markets were so bullish. So whether the demand and supply indicator will really work, whether the affordability is still there, where is the biggest gap where we can get into, and then we can buy the exact investment property into that suburb, which would be the next $1 million suburb. Because now the question is not only about the short-term growth. When you look at the long-term growth, yes, my suburb will grow for another 10, 20, 30%. Whether can that suburb become a next $1 million suburb? Big fundamental question. For that we need a long-term growth. Why to go into that next suburb? What are the fundamentals required? What kind of population is living there? What are the vacancies? And then how do close the deal into that suburb? So similarly, like, okay, I know where to invest. What kind of property should I find? What would be the price of that exact property? How do the due diligence on the property? So to a lot of questions. To solve all these questions, in Propel Next, we source the data from multiple sources. We scrub the data in the backend, and we define the score which identify a suburb which will be a next $1 million suburb. So what kind of key analysis we do from the Propel Next? So basically, there are key pillars. First is demand and supply related indicators. Demand and supply will show you, okay, where the very less supply and the higher demand, where is the current affordability. And then yes, when you go there, because of demand and supply gap, the property will grow in a short-term basis. But why it will grow in a long-term basis? So then we need to look for the macroeconomic indicators, like what's the population size, whether the population is growing above state average, how much they are earning, what are the earning, what is type of population which is coming, what is the family sample size. When we say the population is growing, what's the age group of the population, kind of jobs are available there, whether the economy is diversified, what is the concentration of the each job risk, what are the future projects, what are the risks involved into that particular suburb. So these are all the key metrics which we have already introduced into the Propel Next, and according to that we find the suburbs. So when we look at this is just a sample data analysis how we do into the Propel Next. So when you look at the radar, so that's a key. Sorry. When you look at the radar, so radar means basically it's a scoring system. The 5 is the worst versus the 1 is the best, and according to the ABS, the entire Australia is divided into the multiple statistical area. So statistical area means it's a bigger territory, where the next area, which is statistical area 3, which is called as a council. Statistical area 2 is the suburb, and then statistical area 1 is a subset of the suburb. Statistical area 3 has a bigger boundary than the suburb. So when we do the research on the entire statistical area 3, which is a council. And when, the council is qualified in our criteria, then we go towards the suburb. So when you look at all these data indicators, the first few columns in the red, which are the demand and supply related indicators, but And then the columns which are at the last are the affordability related indicators, because okay, if the demand and supply indicator is very strong, but if there is no affordability, that means yes, currently because of the demand and supply indicator for next 2 years the property prices will grow up. But if there is no affordability remaining within the owner occupier, then it's very hard that prices will go up, because fundamentally owner occupiers can't afford that area. So when the demand and supply indicators and the affordability index are matching, these are the area which will grow in a short term and the long term basis, which allow us to find out where is the actual gap in the prices. That's called as a gap analysis. So we do that as well. Also, we have incorporated census related data. So according to the 2016 census, what was the current population of that particular council? And according to the 2021 census, how much is the population change in that particular area or the council or the broader region? What percentage of the population change is happening? What kind of the population, in terms of the population, what's the age group? According to that, we find out what's the sample size, and it allows us to find out, okay, yes, in that particular region, there is enough population growth is happening, which is above state average. Then we find out why that population change is happening. Is it because of the new job infrastructure? Is it because of the new amenity? Is it because of the new biggest government infrastructure which is coming up, which creates more job? So that helps. So census data allow us to identify that type of matrices. Also, we have introduced a socioeconomic index. So in Australia, we call it the CFI index, where the number 10 means it's a high affluent area. The 1 is the lowest affluent area. When you go and invest into the highest affluent area, which is at the 10, they're already expensive. But there is we have a bigger chances when we go to the mid to low socioeconomic area, where the area is gentrifying. That means good kind of population which is coming there, who has a good income, and if there is affordability remaining, and then if we invest there on time, then over the period of time, you will have a short and long both the growth. So we incorporate that system, and then according to that, when we select the area, our score changes, which allow us to find out, yes, this council has a good demand and supply ratio, council is gentrifying, affordability wise, yes, they are the good income, population is rising nicely, and as well as the incomes are rising. So when we collate all the data, we rank the council, and then we start working into that council. According to that council is selected, then we look for the suburbs, which are the gems within that council, and then we look for the properties. So also we incorporated the jobs by category. So for an example, wherever the job concentration is more than 20% for the major job category, that means all the dependent job infrastructure dependencies on the jobs would be around 50 to 60%. So for an example, if you're investing in a mining town where suddenly if they shut down the mines, then there's a lot of unemployment. So that's why we have categorized that with the major and the minor job infrastructure. Wherever the major job concentration risk is more than 20%, we eliminate that area, we look into that area, we study that area, and then only we get into that particular council. So when we have introduced the Propel Next, what we found out, okay, whenever from last 8 to 9 months, a lot of people were buying properties in regional Queensland, where the valuations are not stacking up, rental proportions are too high. When we do the gap analysis in the regional Queensland, it's failing in our gap analysis because the property prices are overripe. It's not matching the income. So there is not a lot of competition between the owner occupiers, and the investor proportions are growing. We have started buying properties in the regional NSW, where the vendor discounting is pretty high. Now what we could see is basically regional NSW is coming into the growth cycle. Whatever property we bought it around 7 to 8% below market price, now they're coming up to around current vendor discounting is minus 1%. That's additional growth we are getting. So what are the next? So according to the state, we have categorized few councils where we can go and invest and get a good return if you do a proper due diligence and select the correct property. So in South Australia, we are focusing more towards the Treaty Gully Council. So South Australia is if you study the South Australia, you have northern and the southern section, because east and west has the ocean and the lot of mountains. So northern side has a lot of government infrastructure project coming up. So wherever the area is more gentrifying, prices are still affordable. Good government infrastructure growth is coming up. So according to that, our Propel score is around 3.8 out of 5. The next in WA, which is City of Bunbury. City of Bunbury is down south. It's around 140 kilometers from the Perth CBD. Has good lifestyle council where they've got a biggest lithium factory. There is a biggest ring road which is in making. A good kind of population movement. So Propel score is around 4 out of 5. In Queensland, we are working in Queensshire. Again, good affordable council where good population growth. All the demand and supply area for indicators with the short-term and long-term basis are matching. Propel score is around 3.8 out of 4 out of 5. In NSW, we are working in Shoalhaven, Lytton and Wollongong. Propel score is around 4.2 out of 5. In NSW and Victorian Regional, Albury Wodonga, a lot of infrastructure growth. Biggest hospital coming, which will employ around 1100 people. Size BF Factories has great plans. Historical growth is more than 7 to 8%. Propel score is around 4.7 out of 5. So why the Australian property price is expected to rise in 2025? So interest rates are cutting down. There is a lot of gap in demand and supply. Very weak construction pipeline. We still hear that a lot of builders are going under administrations. Huge infrastructure spending underway in multiple councils across the country. And then a lot of government schemes for the first home buyers. From here, I would like to hand over to the Mudit.
Hi, thanks, Julius. Thanks for covering a bit in detail about what kind of analysis you guys do and how do you come up with the right strategy to invest in locations? How do you choose the locations? It's pretty insightful, and I'm sure the kind of data analysis is required for anyone who wants to invest. That's the kind of data research is required. We buy a small dishwasher, let's say, and we do a few days of research. It's a couple of $1,000 kind of worth of asset. But when we're talking about property, where we're talking about $500,000 or even more than that, $1 million, a thorough research is required. And thanks for sharing insights, Julius.
Yeah.
As in terms of PropWealth and Nfinity, we work pretty closely, and we have multiple partners. First thing is that we understand your objective. Like we said, rent vesting, owner occupied, buying either of them. There's no right or wrong in general, right? So one strategy could be more suitable for somebody, but the other one could be more suitable for somebody else, right? So it has to be a tailor-made strategy based on your life, your goals, your current financials, and what's your risk appetite, and how do you see the market, right? So it has to be based accordingly. And then we present the best options to you with due diligence, both in terms of loans and PropWealth help in terms of the property side, right? And of course, we help with ongoing support, build strategy, building the portfolio, reviews, and then periodic updates with knowledge. Just sharing that what our clients speak for us, and it's just good to see that a lot of people, both as Nfinity and PropWealth that we have helped, they've come back to us. They have told their family, friends, and they've written pretty good things about us online, so you can take a look. And it feels good. It feels good when we help someone. It's just those kind words that give us the kick to just put in more and go ahead with more energy. Yeah. And like we were sharing earlier, that PropWealth has created a lot of value for its client. This is just a comparison of how the properties have grown, how the market growth has been compared to how PropWealth's properties have growth in value. So if you look at each one of those, whether we talk about Perth or Brisbane or Adelaide or Townsville, wherever PropWealth invested in the same city itself, if the market grew by, let's say Perth, if it grew on an average by 27%, PropWealth's invested properties grew by 55%. Same with Brisbane, Adelaide, and Townsville. So it's been a massive growth, and thanks Julius for your data insights. I think that's critical in terms of how to fuel, if you're looking at investment properties, how to fuel the growth. And the third point, the bottom row, if you see, 36% equity growth within 12 months. Now that is what when we talk about short-term growth and using that equity to buy another property or building another, using that equity to either buy investment property or if you're wanting to buy a house, that is what kind of growth that you require. This brings us close to our end of the knowledge session. We would want you to, of course, like we said, this is not one size fit all. It has to be customized for everyone based on your individual circumstances, based on your individual goals, risk appetite, financials, constraints, view on the market. That is how the strategy has to be made. So we would be very happy to book a appointment with you, do a one-on-one session where we understand more about you and we will be able to guide you what is the right strategy for you. For that, and that can't be covered in a webinar. So that's a QR code in front of your screen, and our contact details are also there. Julius's contact details, mine. Just you can book a appointment right now with using this QR code, or just take down our numbers and you can give us a call, write to us. We'll be happy to talk to you. And now it's time for some question and answers. Yeah, we would like to take some questions. We can see some questions have already started popping in.
The first question is, do you have a chart data showing appreciation of the properties? Yeah, that's the one. So when the entire Perth was growing at around 26 to 27%, we've delivered around 54.95%. So why we are giving that in the broader perspective is because, I'll give an example. When everyone was looking at demand and supply related indicators, during that time there was a lot of buzz about the Rockingham, because on the every data platform it was showing too good, but we were looking at in a different angle of where the fundamental growth will come. In 2020-ish, the Rockingham was sitting at around 480-ish to 500-ish. And then similarly, at that time, we were investing into the Hawkin. So basically, currently, if you see the Rockingham's median prices are around late 600s versus Hawkin at mid 800s. So that's a difference. So we do have a lot of the similar examples available with us.
Okay, Julius, there's another related question. What percentage of clients have seen this kind of appreciation in properties? So, yeah, you can take it.
There is enough number of clients who have seen this type of appreciation. It depends on the client strategy. So basically, when we look at the detailed portfolio structure from last 3 years, the markets were bullish, and then every pockets you invest in Australia, whether it will be Perth, Adelaide, when you go towards the Brisbane, if you go towards the regional Queensland, now the regional NSW is coming into the growth cycle. So there was enough growth which we have achieved for most of the clients. But moreover, fundamentally what we have achieved is the suburb which we have selected outperform than the normal national average. So around all of our clients, those who are invested with us, have seen the growth.
Okay, thanks, Julius. Thanks. There's another question, Julius. A lot of questions on property. There's another question. There's somebody who's saying that I want to rent west, but I'm not sure about buying a house and land package or buying a property, a house somewhere like established house that you're talking about.
Yeah, so for the rent vesting, the first stage will start from the strategy, right? Because when you are investing, that means you would have a goal in your mind. Either in next 10 years, probably you would like to buy a property in Sydney. So that's why you're building a portfolio where you'll have a great equity, or you wanted to build your passive income, or so on. So basically, when you look at the home and land packages, I'm not saying that every home and land package is bad, but home and land packages are always coming into the areas where there is a lot of supply. So if there is a lot of supply and higher demand, so there is a lot of supply and lower demand in that area, in short-term basis, you will not get the equity. When you buy the property in the areas where the supply is lower and demand is higher, you can achieve the short-term growth, which will allow you to withdraw the equity and then buy the next property. Because in next 10 years, every property will become double. But when you get the short-term growth, so it will allow you to withdraw that equity, so you can jump onto the next property, buy the deposit, and you can enjoy that compound growth. So that's why our preference will be, we'll go towards the only established property in higher demand areas.
Okay. Yeah, that's good, Julius. Thanks for that. There's another question about how long ago was your PropWealth Next strategy of coming up with the scores was implemented?
So, Propel Next was in beta phase around 1.5 years ago. Our system, and so our team and the research team is using it since last 1 year. We've got enough details, and then we improved in multiple segments. At this stage, it's due to release to the market for free of cost. Also, we are planning to introduce the AI related functions and the bot functions within the Propel Next. So yes, it's more than an year system which has already been into the production, and then we are using it nicely. But before that, it took around it's around 2 years to build the entire system.
Okay. Okay.
Yeah.
All right. Cool. Thanks. Let me just look. Okay. There's a question around fees and charges. How do you charge? What's your fees?
Okay, SAR fees is simple. SAR fees is only $12,000 plus GST, out of which we charge $1,100 when you first sign up. We sign a contract with the client. Once we sign the contract, we sit with you, we understand your requirement, we create a detailed strategy which is tailored to your requirement, and according to your goal, we start buying the properties. We select the properties in selected areas where we'll get the first short-term growth as well as a long-term growth. That is always an objective. Also, we try to match a good rental yield, so there'll be not a lot of hit to your pocket. We do negotiate the property. We find a lot of property in off market, so 97% of our purchases are in off market domain. Once we find the property, we do full due diligence. We just don't do bushfire and the floods. We go beyond that. We look for the events, covenant, caveats. We look for the height and cell wires and so on. We give you 2 reports: why we are investing there, what are the future prospects look like, how your cash flow will look like, what are the comparable value of your property with other property which is sold in past. Also, we give you the due diligence report, and then we give you the video inspection report. Once everything is done, and when you selected the property, we come the property contract. Once the property contract is signed, we arrange the building and pest inspection. Once your finance is approved, building and pest is okay, then property management team will come in contact with you, and then once your property is settled, property will be in the market for the rental. Then we look at the entire portfolio. We look for, okay, what's the current equity growth in the property, and then in 6 to 8 months we review your portfolio, and we send you an email stating that, okay, yes, your property is equity ready, this much is your borrowing. We work very closely with the Nfinity Financials, so basically we have access to all your finances, and then we work on the goals.
Okay. Okay.
Yeah.
Thank you. Thanks, Julius. Okay. There's a few more questions there. Are we not out of time? No. Okay. We can take a few more questions. Good. There's a question around I want to buy a house to live in, and what are the first home buyer schemes available for that? Okay. Wait. Let me take that one, Julius. I think I have a slide on that as well. Okay. There are, for those who are looking to get the benefit of first home buyer schemes. So government has and these are state government based or the federal based. There are multiple schemes available for first home buyers who are looking to buy owner occupied properties to live in. There's schemes around stamp duty waiver. You can either get full waiver or partial waiver of stamp duties. This varies as per each state. To give you an example, in NSW, stamp duty up to 800K property is fully waived off. 800K to $1 million, there's partial waiver. Up to above $1 million, there's no waiver. Then there's LMI waivers. They're called first home guarantee schemes. These give you LMI waiver, so you don't have to pay LMI. It will be covered by the government. Those who don't know LMI, it's called Lenders Mortgage Insurance. It is an insurance that you have to take if you're taking a high value of loan. The mandatory insurance that the banks mandate you to take to protect the lender. Okay. But there are also, LMI can be waived off in multiple other ways also, based on your profession, or some banks have LMI waiver schemes going on up to a certain loan amount that you're taking, loan percentage you're taking. Then there are first home grants, where the government is giving grants straight away. These again vary state to state. And so each of these schemes also have eligibility criteria, property price cap criteria and all. So before you go forward and think about the scheme, you discuss with the professional, with the mortgage broker. You can come to us and we can help you understand how the schemes are. And then there is first home super saver scheme, which is that you contribute voluntarily to the super, then that money can be used towards your purchasing of the first property, and basically, yeah, you save some money on tax there. These are some first home buyer schemes. There is some benefit available, definitely, and the government is doing its best to help people buy their first home. Having said that, you need to weigh off the benefit you are getting by the first home schemes, and weigh it off, because there's always a trade-off. If you're getting this benefit, then you are buying a certain kind of property. So you always, like we were discussing earlier, that you have to weigh it off against what kind of property you're able to buy using the first home schemes, versus if you buy something else where you may not get first home schemes. That is the trade-off that has to be done, right? And that's where, when we have a one-on-one meeting, we can help you based on your personalized scenario, that which one can work, what kind of numbers will be there. Yeah? We have 2 more questions. If current PPR is not, sorry, 1 second, not aggregate to your future needs and you save 25%. That's a pretty long question. Okay, I think it's a pretty long, very specific scenario about somebody 55 years old with 10 years of working life. Would you invest in 10 years or sell PPOR and then buy another one? Sorry, this is a bit detailed question. I think it will be better that we can take it offline. It will be good. You can just leave your number, book an appointment, and we can discuss this in detail, because it's a very specific scenario on a certain age, and then advising on a certain strategy. Yeah. Okay. We have limited time, so we will just take maybe 1 or 2 more questions. Next question, Julius, can you take it? This is PropWealth Next available currently? Is it free, or is there a fee for this?
Okay, so PropWealth Next is currently available only for our research team, but we are planning to release a subset of the PropWealth Next to market in next 2 months. It will be integrated with a new website which we are launching, where it will be part of the research hub. You can have a full access to the maps, as well as you'll have a full access to the trends of the particular council and the suburb. Also, in future, we would add another few filtration criteria which will allow you to understand which kind of metrics to use, and then how we select the particular council. So it's a long due process, but yes, it will be available for free in next few months.
Okay, cool. I think we'll take just one more last question, Julius, because sorry everybody, we are it's 8 o'clock. We're just stretching, so we'll just take one last question. My budget is 700K currently. I know that I'll be getting more money later. So what strategy would you advise for me? Should I buy a house to live in, or buy an investment property? Okay, I'll take this, Julius. Yeah. So if you have budget is 700K right now, and living in this is Sydney. Okay, if you're talking about a 700K budget, and if you're living in Sydney, yes, let's look at both the scenarios. If you buy a property to live in Sydney in 700K, you can possibly buy a unit. House is going to be very difficult, a fully detached house, because generally the price have gone up, and a house will cost anywhere upwards of $1.2 $1.3 million and above, even if you're talking about going a bit far off suburbs. So if in that budget you can get a unit, yes, the first strategy, if you buy a unit, yes, you can buy it. And then if you're expecting funds to come later, more funds to come later, like you said, you can use that money to buy investment property later. The only thing is, generally, historically, if you see about units in Sydney, most of the units have not kind of grown much in value the way houses have grown. So if you're buying a unit to live in today, few years down, 5 years down, 7 years down, you may not see much growth in the value of that unit. At that point of time, you will either choose to sell it off, make it investment when you're buying your house to live in, moving to a bigger house, upgrading the house. Either you will put it as an investment property, or you will probably sell off, right? So that's one strategy. The only thing there is that, yes, if you wear the investor hat, then you see that is it a good investment. Of course, you will be able to buy it in a certain location. Alternate strategy is if you don't buy a unit to live in, the other option is, like you said, that you continue on rent, invest somewhere in property. If you are able to do a good research around where to buy, what kind of property to buy, chances of capital growth can be much higher. In 5 years itself, if the property grows by 10% in a 700K budget, you're talking about good, maybe 200, 300, 400K. Even if we be conservative, let's say, even if not 10%, even if it is 5%, 7% capital growth, still you're talking about a few 100K kind of capital growth. So that is the trade-off. So, but yes, of course, you'll have to continue living on rent for some more time, right? So if that's okay from, like we discussed about social, emotional factors. So if that's okay, then that's something that you have to weigh off. But like I said, it will be better if we discuss this one-on-one. This is still a bit generic. We need to understand a bit more about your financials and circumstances. All right. I think we will call it a webinar. We have extended by a few minutes. I'm very sorry for everyone to keeping you for another couple of minutes, but just that there were so many questions to answer. There are more questions, but we can take them later. We can take them offline. You have our QR code. You have our credentials there. You can book an appointment. Sorry, you have our credentials. You can just book an appointment. We will be very happy to discuss your scenario with you, and we can then take it forward. Yep. And thanks again. Congratulations to invest in your knowledge growth, and see you later.
Thank
Bye-bye.
you.
Thank you.
Bye.
Bye.